debt obviously is exploding. Uh, the Treasury, they're actually borrowing an extra $1 trillion every 100 days now. So we're in the exponential phase as far as the debt buildup. And understand that the reason asset prices are where they are or where they got to was fueled by credit. It was fueled by debt. And what's happening now is we're basically at the debt saturation level where, and I say debt saturation, all you have to do is look at the debt service in the U.S. It was over $1 trillion last
1.1.
year for just right, just the interest alone. We'll probably end this year, I don't know, 1.5, 1.6 trillion. Mathematically, it doesn't work. Uh, Historically, the way to reflate, if you will, historically has been war, and obviously that's on the front burner now with what's going on with Iran and Israel. Uh, I think the first salvo was basically a test, if you will.
We know this political Zionism, the war feeds inflation. It'll certainly in due course feed through the oil price. It's obviously feeding the big fat calves of the military industrial complex. America's actually funded both sides to some degree under Biden, I'm understanding as well. So it is a debt jubilee of expenditure to pay two prize fighters to put on a fight that you've essentially funded. And what does that mean? It feels to me we're in the quickening phase, doesn't it? You mentioned parabola, and I entirely agree. In fact, there's very little when you come on that I don't find alignment with. We seem to be in a quickening phase because, as you pointed out, the interest rate payments can't be paid. They're having to roll. The debt is shortening, so there's much more debt that needs to be rolled. We're actually in the phase where the appetite for that debt, there was 62% from foreign buyers actually on a very poor bid in the last issuance, a very, very poor bid. And I wonder if you took out Japan, that is strong-armed into buying, and Britain, that's part of the same axis, and you took out the Luxembourg, Belgium surprise wild card that always seems to be an offshore self-monetization plan, who actually of the outside America are actually buying. It sure isn't the Russians and the Chinese, and they aren't bidding anything like they used to. The appetite of debt is going to lead to an interest rate spike more than all the pivots and cuts is been our position for a long time, especially with inflation. Give us your feed and thoughts on that.
Yeah, I mean, obviously the buyer of last resort, or when it happens, the buyer of only resort will be the Federal Reserve. And you're probably looking at Federal Reserve action behind Luxembourg and Belgium. That's I don't believe that's real capital. Uh, I
100%.
have been on the record saying that there's been nothing but talk of rate cuts. Now they're talking about less rate cuts. Uh, yeah, if something bad happens financially, something breaks, yes, the Federal Reserve will cut rates, but it's my opinion that market rates will go higher. You'll see a brief downward move in rates, but the direction of interest rates from here is up, not down. And one thing that's not been accounted for, I guess you could say in our lifetimes, Francis, is risk premium on the interest rates in the U.S. I mean, they talk about real we have real interest rates, positive interest rates, and I don't see that as the case at all. I mean, inflation is far outstripping the coupons that are issued on treasuries. That's a negative real interest rate. So it just seems to me that rates are going to go higher, and that will be a function of risk premium, which we've not seen in our lifetimes. Lenders must be compensated for the risk that they're taking. And in the US, for 50, 60 years or longer even, has been considered a risk-free rate of return. And I think
Yeah.
uh, the big awakening at some point, probably this year, is going to be, hey, wait a minute, there is risk in owning U.S. sovereign treasury debt.
Yeah. Yeah, I agree with that. In fact, I was just looking for a tweet that was showing all the junk foods uh, businesses and how their prices have gone up in the last 2 or 3 years. And you're looking at McDonald's on about over 100%, and most of the other basket of junk food providers in the 70 to 80% range. And that's cheap food. You know,
Right.
that's a lot of our working poor that are eating out there, grabbing something quick on the run, heading off to the office. There's no way that statistically that is represented. And I want to comment on the other point you made, is that we were always told, I did an MBA, and every business analyzed had to be on the risk-free premium of the 10-year treasury, which essentially was a zero risk investment if you weren't delivering an internal rate of return beyond that. And the point you're raising is that entire fundamental principle almost no longer holds now on the basis of absolute proliferation. And in actual fact, the premium should already exist. It should already be pretty damn high because we're standing at a guaranteed failure. It's almost, and never mind that we actually have junk debt as well in HYG, how that is still trading at the levels that it's trading with such a category A splurge is beyond me. So, I mean, those are two very good points. I don't know if you have further to say on that, but it astounds me.
Do. Yeah, one other point. The issuer of dollars themselves, the Federal Reserve, lost $156 billion last year. That more than wiped out their equity. So you have a multi-trillion, if you include derivatives, uh, two
Quadrillions.
plus quadrillion dollar, yeah, quadrillions exactly. You have a system that's the foundation is negative equity.
Yeah.
So you have basically what we have is a Federal Reserve that's broke, technically insolvent. And oddly enough, and I talked about this last week. Oddly enough, last week there was I guess it was an undercover uh, story on the Fed that inside the Fed they've become woke. They believe, their monetary policy has got to combat climate change, has got to align with DEI. So now you have a Fed that's woke and broke. And I mean, that is the world's reserve currency. That's what the world is running on, which is the I guess the best way to say it is the world financial markets are running on fiction.
Well, it's so funny to have the peak always nation state of capitalism actually being run by a Marxist agenda, both culturally, socially, and quite clearly economically.
Right. Yeah, it's a clown show.
So, gold. We've discussed debts. Tell us, are we not? Is it not serving exactly its role? And I don't need to. In fact, it's probably worth also bringing up not just the gold chart, but the gold chart. I'd like to bring up the gold chart versus the yen because we've also had the dollar. Because of these rate cuts, we're actually getting this perverse result of dollar dominance at the moment, and it will be, and it will
Right.
intensify. In other words, this whole system fails on a dollar strength spike and an interest rate spike, which has to be led by the Feds because they proliferated, they created the inflation. They now have to be at the forefront of fighting it as debt collapses, which will see in the order of collapse the emerging market nations that are offshore dollar debt. They're going to be forced into proliferating their currency to try buy dollars to make higher interest rate payments and that's going to further exacerbate. So surely we're going to be due some serious FX volatility, with the dollar being a wrecking ball on the smaller nations. And then eventually we'll have the World Economic Forum saying we didn't need that many currencies, and normalizing what didn't need to happen. How's your pecking order in the I suppose the order of events, these cylinders? We've got a V12 here. What's the firing order of collapse in terms of this?
Yeah, actually, I mean, it's hard to look at the order, because there are so many potential matches to throw on this bonfire. Uh, I would say first, I would say if you think gold has been strong in the dollar, look at gold in other currencies. Look at gold in euros. Look at gold in British pounds, yen, whatever. Gold is exploding. And actually, let me just go back. Gold's not exploding; it's the currencies that are imploding,
Correct. Yes.
because the the common way of measurement is, you measure an ounce of gold and how many dollars or yen or euros or whatever it takes to buy that. In reality, that's not the case. An ounce of gold is, from 100 years ago, from 1,000 years ago, is still just an ounce of gold. It's that
Yeah.
same ounce of gold. That is the measuring stick. So really, this run, gold has gone from 1/1900th of a dollar to, I'm sorry, the dollar was
One
one
nineteen
nineteen
hundredth.
hundredth. Now it's 1/2400th. So what's happening is the currencies themselves are imploding. It's not that gold and silver or even a cup of coffee or anything else is going up in value. What's happening is the currencies are declining, and it's taking more currency. As far as the implosion, and I do agree with you that a stronger dollar obviously is going to work as a wrecking ball in the financial system. And what that'll do is it will wreck emerging market financial systems, because they simply won't have the dollars to repay. And that's
Yeah.
what you're seeing now, is that, while so many of these contracts in the past were done in dollars, and uh, you have you have many entities scrambling to buy dollars to pay down their debt. And I mean, that's bleeding off, but what that's going to cause is it's going to cause some failures. It's going to cause some defaults. And once you get defaults in a system that is leveraged as high, or as much as this system is leveraged, that infection spreads, and it spreads all the way up the chain, and obviously ultimately to the reserve currency of the world, which is the dollar. Uh, and of course, treasury debt itself, as we spoke a little bit earlier, treasury debt itself is mathematically infected. It cannot be paid off in current terms. The only way to pay it off is basically to print the dollars, uh, which dilutes the dollar. So that's, you're looking at a strong dollar that's cutting its own knees off by forcing newly created dollars to pay off the current and past debt.